Welcome to Trading Nation. I'm Seema Modi. Energy stocks can't catch a break. The group is the market's worst performing sector on Tuesday, this week, this month, and this year. With analysts and investors alike setting their sights on alternative energy sources, is there any hope ahead for the energy space? I'm joined by Bill Baruch of Blue Line Capital and Boris Schlossberg of BK Asset Management. Boris, the key thing here is this industry is innovating at a very fast pace. What does that mean for the traditional oil giants?
Yeah, well, I think the death of the hydrocarbon is kind of greatly exaggerated. Yes, as Daniel Yergin, who is a very famous authority on the energy business, said, it took 200 years to go from wood to coal, and then it took another 100 years to go from coal to oil. It will eventually go to battery power, but I think the market at this point is kind of thinking it's going to be a decade, and I don't think it's going to be a decade. I think hydrocarbons will be here for quite a while, and there'll be a big transition period. And for that reason alone, I think the energy sector at this point actually presents a pretty decent value, especially because right now, from a financial point of view, there's this sort of a game of chicken going on as far as dividends go. Exxon is at 10%, Chevron is at 7%, and they have not said that they're going to cut their dividends, which means that if they do not, that makes them one of the greatest yield plays in the world right now in a time when the 10-year is trading 65 basis points. Now, if they do cut the dividends, let's say they even cut it by half, that still makes it a very attractive yield, and at the same time also lowers their cash flow needs, and therefore I think has a chance for the stock value to go up. So in my opinion, I think if you're a long-term holder, this is one of those great opportunities where you have a chance to buy a very, very beaten down sector relatively cheaply for the intermediate term, even though very, very long-term, certainly the prospects for the whole sector are kind of negative.
Bill, you've been going through the charts from a technical perspective. What do you think?
Well, I do agree with Boris here in this weakness that we've seen here this year. I think it presents a longer term value opportunity. In the near term, we're seeing a lot of pressure today, and I think one of the reasons is actually a story I've been really talking about and writing about a lot over the last 2 weeks is when the Saudi oil minister came out 2 weeks ago with harsh comments. I think it was really a fear, masquerading the fact that there's going to be undercompliance in September. And we started to see some data today. Russia with an uptick in production, just a shade under 10 million barrels per day. It's higher than the about 9.84 they had in August, which is obviously higher than July. So I don't think they're the only ones. So that's where I think that's the major catalyst to seeing some pressure across the space today. With all of that said, though, I think there's tremendous value in crude oil, 34 to 35 bucks. And even amid all the weakness we've seen over the past month or so, and a lot of doom and gloom 2021 outlooks that are just with lockdowns, and I think that despite all that, crude hasn't gone down there in and of itself. That shows that the market is finding a good support level, good value in that range. So I like crude at $34 to $35 over a long run. And although if it gets down there, it's going to continue to pressure the stocks. I think there's great value in the stocks. I think Chevron is really a great one. I've started to allocate to energy last week with Chevron being a centerpiece to that. $70 in Chevron is a good point of balance for the stock. And as Boris mentioned, those dividends, they're really great right now. Even if they do end up cutting those dividends, you could see a flush. I think that flush would be a buying opportunity. So I've begun allocating to space, and I think it's good value there over the long run.
Boris, I thought the economy was accelerating at a faster pace than expected. Sure, the unemployment rate is stuck above 8%, but we've got a new report out, new jobs report out this Friday that is expected to show a dip below 7. So there are signs of strength here, or signs of improvement, I should say. Why is oil continuing to sell off?
I think because the market is adjusting to the massive global shock or the global reallocation of how people actually live. There's so much of spending now is virtual, so much less commuting. I mean, commuting will be, I don't even know if commuting will ever come to its former levels, but it'll certainly be below its levels. Today's story that Manhattan offices are only at 10% capacity. I mean, that's massive shock to commuting, and that's a huge part, I think, to oil. But, irrespective of all that, demand for oil, demand for energy will continue going forward. And I think that's really the key story. What I was going to say is that when you have these situations where the industry is really starting to decline, the big major positive catalyst is M&A activity. So I think when you see the majors begin to merge, when you see Chevron and Exxon possibly merge, that's going to be actually a very positive catalyst because it will take a lot of capacity off market give them much greater pricing power, and in long term, they'll be positive for investors.
Yeah, we'll have to see if consolidation is in the cards. Boris and Bill, great discussion. Thank you for joining us.